Can you guys see my screen?
Yep.
All right. So what was your question?
So the main questions are, where would you put the stop loss using the point of release,
Okay.
and what kind of market structure you ideally want in combination with it?
Okay. Yeah. So as it relates to market structure, and then where's the invalidation? All right. Yeah, that's easy enough. So the idea generally is that we have a point of release right here, right on the daily. A lot of times you'd want to go down to the lower time frames to refine it, right? Because yeah, you're looking at your time frame, but price is price on all levels. Um, so we could go down to a 2 hour to kind of refine it a little bit, but it's actually the same level on a 2 hour as it is on the daily, right? So that's pretty interesting. Usually it's a little bit different, but this is exactly the same level as we have on our daily chart. Um, so that gives me a good deal of confidence that is in fact the level we're looking for. And then to answer your question um, about where do you manage risk, well, so there's two ways to answer that question, right? You could manage risk in multiple areas, right? Like you could manage risk below here. You could manage risk below here. I would definitely put a stop here, at least, especially. So there's two phases to answer that question. So I would definitely put a stop here when price is reaching for this level, this point of release that we have here. Let's see. It's actually right here. So so this is where I would frame my entry, right? If I'm trading the point of release, I have this clean break marked off here, but for the purposes of this video, we're looking at the point of release down here. Now, if price reaches that level, maybe we have a limit order there. Maybe we're sitting there with our finger on the trigger waiting to enter a market order. That is actually the most efficient way to do it, but requires more patience and more diligence. But either way, then we would have a stop here, right? Because we might be interacting with the market here and it just shits the bed, runs through. We want to have our risk managed here. You could also put it a little bit lower just in case price runs below these lows and then, runs up, then you don't get stopped out. So actually, maybe you manage it. I would say the ideal place to manage is probably somewhere like 38, just below 36,000. That's so if you're playing it like this, then price can hit these stops, right? And not hit your stop, essentially. And but then the time or the trade takes time to build out, right? So as you come down to this level on the 15-minute chart or the 1 minute chart, right, you will set lows in here, right? So there'll be lows around this level. And ideally, what you want to see is, say, the 5 minute would set in a low here, and and then start moving upward pretty quickly. And that's really important for this, because another element of this is if you see like price coming down and trading below these levels for like a significant amount of time, right? Say it comes down, closes below, doesn't necessarily take out these lows, but just closes below the point of release, closes there, maybe bounces a little bit, but then comes back below and hangs out down here. That's a bad sign. That's a bad sign. You want to see it hit and then react pretty immediately. If I see it coming down and hanging out below this area, then I'll start to close that position and even look on the smaller time frames for an entry for a breakdown. That's a really important point. But then, yeah, of course, as it moves up, there will be profit targets along the way, especially on the lower time frames, right? Because you will have price come down and it'll set in price distinctions as it's coming down that we can't see right now. But if we were doing this in real time, we'd be able to see those. And we'd be taking profits along the way at those levels. And as we're taking profits, we would also move the stop up, right? So at my first take profit, I had it just below these lows, and I'd move it up to the lows. And then as I take my second profit, I may move it up a little bit. And then by the time I am at my third profit, then I'd be able to move my stop up to break even, essentially. And that's kind of the way I would be framing that. And then if you wanted to get even in more detail, you could, as price is moving up, you could even get into the lower time frames. Like if you went on the 5 minute time frames, there would be small retracements within there that you could also enter a point of release at. So you could layer in as you're taking profits on the upside and you get these small retracements off those levels, then there would be the same price distinction on the lower time frames that you could, a point of release within that area as price moves higher that you could use to add risk, right? But the idea is that as you're taking profit, you want to be netting profit off. So say I'm taking 20% off at the first price distinction, then maybe I add risk on a 5 minute retracement, but I don't want to add more than I take off, right? The idea is to be taking off risk. So maybe I take off 20, add 10, but that's like a dynamic way to manage your position. The idea being that as you're hitting your take profits, you are taking risk off in the aggregate. Then, as it relates to market structure, so you have your break of market structure here, and essentially this is your break of structure. So this is kind of a very significant point of release too, in a sense that um, it's a point of release that broke market structure on the daily, right? Which is pretty uncommon. You don't get that a lot. I mean, the last time that happened was let's go find the other last time that happened. So yeah, right here. The last time I think that happened was, well, actually, technically up here. So this is a little bit of a break, but really your big break that really fucked everybody over was up here. And so of course, this is you would also have a point of release up here, right here. Now, of course, market didn't give you a chance to trade it, right? But if it did, right, if it had, that would have been a pretty significant level because not only is this a 2 hour chart, I mean, this is the daily break of structure right here. So and even I think even if price revisited it later, this is back in November, but say we get up there in March or something like that, this level would still be pretty significant. But yeah, let's move back to current price action. Let's see what we got. Yeah, so anyway, you have your point of release here that broke this downtrend on the daily time frame. Yeah, so that would just add significance. I mean, I would trade this with more risk than I would, I'd max out my risk profile just based on what's happening on the higher time frames. But of course, I wouldn't get crazy with it. I would, just max it out within whatever your max profile is.
Yeah, sure. Thanks.
Um, yeah, and then that idea, stops being valid below these lows, just in general.
Yeah, so do you have any invalidation for not taking the point of release? For example, too long of a consolidation at the top or uh, little impulsive price action, maybe too sufficient price action, etc.
What do you mean, like if price?
So if you have a point of release and like the price is here at the top, but would there be any invalidations to not take the trade? You can see already before the price hits your point of release. Like if the price is too sufficient, then you wouldn't take the trade.
Um, That's a good question. I mean, so let's say, so hypothetically, right? I mean, this trade is kind of framed within the higher time frame trade, and I really like that. Uh, so we have a higher time frame level, right? Downtrend comes down, hits that higher time frame level, and then breaks structure here. So you kind of see how this is like this fractal nature is starting to play out, right? So the lower time frames are colliding with the higher time frames. As that happens, you can see the market starting to shift around at that point, right? Comes down, bases off it, comes down, breaks structure. And so I really like that. So it's another reason why I really like this trade. So I guess to answer your question, if it were the other way around, if this trade were like directly contrary to the higher time frames, that would be a situation where, uh, and volatility was picking up. Maybe I'd be like, well, I don't really want to stand in the way of what's going on in the higher time frames. So that would be a signal to do that or to kind of stand back a little bit. But that's not what we have here. Actually, we have the opposite, right? We have the high time frames like being in line with the trade idea. But yeah, to answer your question, if it were the other way around, that might be a reason I wouldn't take the trade.
Very nice.
Um,
And so my last question will be talking about the wicks of the point of release. Is there like a ideal situation, or it doesn't really matter if there is a wick at the top of the candle or at the bottom of the candle?
you mean like a wick? Like so here it's like nice and clean here. Like if it were a wick
Yeah,
down.
is indeed.
I don't know, man. It really there's really no orthodox way to describe it. It's basically the idea is just um, so there's two important distinctions to identify here, right? It's and you can see it better if you go to the low time frame, but basically you have this high right here, right? That's broken. The market structure is broken, so you can go down to the very low time frames and find analyze a low time frame low that led to the break of structure, right? So the market is kind of trading sort of efficiently here within the context of a daily downtrend, right? So yeah, it's basing off high time frame support, but it's still in the context of the daily downtrend, and it hasn't broken that yet, right? So it's kind of moving in an efficient, orderly uh, fashion. In this case, accumulating at a high time frame level, right? Even though we have our breakage structure on the low time frames here, we still don't have the break of daily structure yet. We don't get that until right here, and we showed that on the daily chart. But anyway, yeah, price is moving efficiently, accumulating at that high time frame level, but it breaks daily structure here, and so this is the area you'd want to mark off in your chart, right? Price is moving. There's a change in behavior, right? Volatility expands. It breaks daily structure. If you had volume on your chart, you'd probably see a massive flush of volume, and that's how you identify this level, right? So it doesn't matter really what the wick is. I would use the wick. Sometimes if there was a long wick here, I would put that on that level to mark off the low. Um, but there's no perfect way to do it. To answer your question, as long as you've identified this level, right? As long as you've identified the correct level, um, using the wick or the body just comes down to personal preference. I would say. I don't know. Does that answer your question?
Yeah, yeah, sure.
Okay.
Thanks. Yeah, that's all.
Okay. Um, yeah. Any other questions?
No, let's go to Martingale.
Okay. All right. So we have our trade idea outlined here, and we kind of mentioned different areas that we would manage risk, but just for the sake of simplicity, we'll just use this level. And say we're trading this price idea. Say we identified the clean break here, and then we were talking about the point of release, and then we also have our lows here. So kind of the idea with the Martingale principle is we have this greater trade idea, but we can break it up into three separate trade ideas. So we have a level here, right? Kind of a shelf or price pause right here. So this is the level where price could come down and base off this level and then continue. So if we were to break this trade into three ideas, maybe we look for a trade at this level. Hold on, I'm kind of running out of time here, so